Hello everybody, good morning, good day. This is the Forex Fundamental Analysis for July 6th, brought to you by OctaFX, an award-winning broker that has one of the lowest spreads in the industry. Let's begin with some housekeeping, a few disclaimers. Risk disclaimer: trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. You should not invest money that you cannot afford to lose. And a hypothetical trading disclaimer: all the information provided here in this webinar is provided as general market commentary and does not constitute investment advice. A few quick words about myself. My name is Yohay. I'm a Forex analyst, used to be a retail trader and a computer programmer. I founded Forex Crunch in 2008, where I focus, as here, on fundamental analysis. Of course, we'll touch on technical stuff as well. On the agenda today, the stories moving the markets as usual. The next events to look out for will have a special focus on the non-farm payrolls, key levels of support and resistance for all the pairs we cover. And the pairs are, when we talk about the dollar, we'll focus on dollar-yen, okay? With the euro, of course, euro-dollar. We'll talk about the confusing pound-dollar, the Australian dollar losing some momentum, and the Canadian dollar, which still looks good. Okay, so what are the main stories that we're talking about today? We had geopolitical rattling in North Korea. The regime there fired what's called an ICBM, Intercontinental Ballistic Missile. This happened just on the eve of Independence Day in the United States. We've seen an immediate reaction, as we talked about, in favor of the Japanese yen. When there's trouble in the world, Japanese yen strengthens. But the world has a low attention span, and then dollar-yen recovered quite quickly. All in all, the US dollar maintains its recovery. So last week the US dollar was on the back foot, and this week it's getting a bit stronger. It began before the news from North Korea, began at the beginning of the week, and the dollar is recovering. Now it seems to have reached some kind of a halt. We had yesterday the Fed meeting minutes. These are the minutes from the Fed decision back in June. June 14th, the Fed raised interest rates. Not only did they do that, but they also had a more optimistic, hawkish tone. They shrugged off low inflation as temporary. They were talking about strong growth, about higher employment. Everything looked rosy, looked favorable for the US dollar. Okay, and now we got the minutes from this, so around 3 weeks later. We didn't learn too much. In terms of, we didn't get a clear signal because the Fed is a bit split. Some are more optimistic, want to begin reducing the balance sheet, printing less money from September. Some want to see it only at the end of the year. Regarding interest rates, we didn't really learn anything new. What we always know from the Fed, the Federal Reserve, is data dependent. If the economy looks good, they will raise rates, it'll be positive for the dollar. If the economy doesn't look good, they will not do that. They will wait and see, and this will be negative for the dollar. And biggest points, data points, are coming out this week. Well, tomorrow it's the non-farm payrolls. We'll talk about that. Open question again that will be asked after the non-farm payrolls and asked also now. Will the Fed raise interest rates once more this year? December is where analysts are converging, bond markets are converging, but nothing is certain. Okay. We had the 4th of July holiday in the US, and now it's full volume once again. So in terms of data, it was a bit mixed, a bit disappointing. Factory orders, well, mixed would be the better wording. Factory orders disappointed with the drop of 0.8. The optimism index also fell, a small drop, but the most important figure that we had so far this week is the manufacturing PMI. It beat expectations with 57.8. Bigger data points are coming today as a preparation for the non-farm payrolls. So at 12:15 GMT we have the ADP non-farm payrolls. Now this is a private sector report which serves as a warm-up for the non-farm payrolls, but the correlation is not always there. For example, last month we had a superb report from ADP, showed 250,000 jobs gained in the private sector. The actual figure from the government was that total jobs, including government, rose only 138. So watch out. The ADP impacts markets on its own, but is not necessarily a hint for the real thing, the more important event, the non-farm payrolls. Another big hint comes today from the ISM and non-manufacturing PMI. Non-manufacturing is a long word for saying services sector, which is around 3/4 of the US economy. So this indicator will also be of interest as a hint towards the jobs report. We also have number 2 at the Fed, Stanley Fischer, speaking tonight, sort of in between these data hints and the big event, and of course non-farm payrolls tomorrow at 12:30 GMT. Before we preview the NFP, talk about other events, we have the G20 Summit this weekend. The leaders of biggest countries, most important countries in the world, United States, China, Russia, European countries, Australia, 20 major countries are meeting in Hamburg in Germany. Of course, it'll be interesting to see how Trump administration deals with North Korea, with Syria, and with trade issues. So let's see what the tone could have an impact on the open on Friday. If we have more agreements there, it's better for markets. Less agreements, it's worse. Okay, and if we already look forward towards next week, we have a testimony by Janet Yellen next Wednesday. We'll talk about that more in detail next week, but in any case, she's certainly influential. Okay, non-farm payrolls. First Friday of the month, always the big events. Expectations stand on 175,000 jobs gained, which would be better than what we had in May, 138,000. Now, this the figure for last month will probably be revised. We never know if it's to the upside or to the downside, but these kind of revisions do have an impact and they can be quite wild. Okay, the unemployment rate is expected to remain at a very low level of 4.3%. But I always say this, the unemployment level is of course very important politically. That's a number that is quoted by everybody, but it is also a result of the participation rate. So if you have less people participating in the workforce, and out of these people, less people are unemployed, it's not such a big deal, okay? So it's good to have a low unemployment rate, and the US economy is gaining jobs. It's all good news, but 4.3% is a bit going too far. I mean, it reflects many countries would envy 4.3%, but not all the countries in the world would envy the current state of the US economy. Okay, what we should focus on, I'll repeat this again and again, is wages, salaries, because when you have the economy reaching full employment, in theory with 4.3%, that's where we are, then employers find it hard to find employees, so they raise salaries. People have more money in their pockets, they buy more stuff, they push prices higher, the Federal Reserve raises interest rates, and we have a stronger dollar. But if wages are not moving that fast, then it's a problem. So wages now are expected to rise month over month by 0.3%. They rose last time by 0.2%. So expectations are relatively high. Last time we had a disappointing wage report in terms of the year-over-year figures, only 2.5%. Basically, it's stuck. It's not terrible, but the U.S. economy is not getting close to full employment. It doesn't really justify a rate hike, okay? So the year-over-year figure, which is also impacted by revisions, okay, for last month and the previous one, it could be the most significant thing. More important than jobs, that's clear to see. Wages are behind again. Core inflation means if we have higher wages, we eventually have a more sustained rise in inflation, better justification to raise interest rates and to push the US dollar higher. Okay, now what do we expect in terms of market movements, of course? First of all, before we have the number, we'll have a few changes in expectations depending on the data coming out from the ADP and the ISM non-manufacturing PMI. And let's assume that job gains are in a wide range between 100,000 and 240,000, more or less a wide range around the consensus, which is around 175,000. In this case, I believe that the number of jobs gained will not have an impact, okay? Of course, if we have a terrible number in jobs, it'll be bad for the dollar. If it will have a superb number, it'll be great for the dollar. But assuming we have a wide range of options in between, then wages remain the most important thing. Wages of 2.7% or even higher, that's US dollar positive. That means that the economy is picking up, people are getting higher salaries, and inflation is set to pick up. If it's around current levels, 2.5, which we had last time, or even one tick higher, 2.6, I think it'll be neutral. More of the same, we'll have to wait for more data. We can have Fed officials, some of them more optimistic, some more pessimistic, more of the same. If wages fall to an annual level of 2.4% or even lower, of course under 2%, well, it's probably not going to happen. Changes are not that big. Then it'll be US dollar negative. We'll have doubts if the Fed will raise rates this year. And so rate hike expectations again are shaped by wages. Okay, in the big scheme of things for dollar yen, it's the most sensitive currency paired to US indicators, will have the best reaction, logical reaction, let's put it this way, to the non-farm payrolls in dollar yen. It moves with the chances for a rate hike, goes hand in hand, falls and rises with Trump, although we're seeing less of an impact from politics on the US dollar. But I'm mentioning this again because we have the G20 meeting this weekend, and falls and rises with risk. So dollar yen, when we had more optimism about the world, I mean, no trouble, had dollar yen having support to the upside. When we had this issue with North Korea, we saw it falling. The fall was not sustained, but we certainly saw a reaction to that. Now let's look at the charts. We're talking about the MT4 platform, the OctaFX MT4 platform. Let's move to dollar yen. Here we are, 113.30. All in all, the uptrend continues, but we might fall off this uptrend support, okay? Because we're closer now, a bit closer to the bottom of this range. Again, the most important event is the non-farm payrolls. If we talk about levels from top to bottom, if we have an excellent jobs report, we're looking at 115.45. Under that, we have 114.30, the cycle high, 113.45. A recent high, we made a small break above that, but we never went too far. 112.60 is a line of support right here. Then we have 111.80, 110.70, and much lower, 108.10, the cycle low. Okay, so we're currently in an uptrend on dollar yen from the lows, still within the wider range of 108.10 to 104.30. I am a bit skeptical if the uptrend can continue. Okay, let's continue to the world's most popular currency pair, euro-dollar. So euro-dollar is, had an excellent week last week thanks to Draghi. Now it's beginning to slide. Okay, so it's mostly US dollar strength seen across the board, but also a member of the European Central Bank, Benoit Coeur, probably not pronouncing his name correctly. Anyway, he said that no change in policy has been debated. Now, markets are anticipating that the ECB will begin printing less euros, tapering of the QE program next year. And when he says we didn't even talk about it, it was negative for the euro, kept the pressure on. Okay. In terms of indicators, the services PMI is released yesterday. Indicators for service sector have been quite strong, quite positive, lots of optimism about growth in Europe. On the other hand, producer prices are falling, so also in Europe inflation is not that strong. Okay, German retail sales beat expectations with a rise of 0.5%, but factory orders fell short of expectations, rising by 1%. The European Central Bank moves the euro much more than these figures, which are not the most important ones, not as important as inflation and GDP. Okay, today we have the Ecb Meeting Minutes. It's 4 weeks old, a bit stale, but can still move markets if it gives us any hint about the next move of the ECB. Again, we have contradicting reports from everywhere. Tomorrow we have German industrial output, Now, if the factory orders disappointed, maybe industrial output will go the other direction. It happened too many times in the past. Anyway, it shouldn't be such a big market mover, especially ahead of the US non-farm payrolls. Euro-dollar movements in general, after a big Draghi speech, the ECB and the Fed are now a bit more balanced, but it changes every day with every statement. I see the current move to the downside from the highs as a correction, not a change of direction, and from here we could see the pair rising. Okay, so I'm a bit, I think it's a healthy correction, but not necessarily change, of course. Growth is still stronger in the Eurozone, according to the data we have, and politics look more stable in the Eurozone. We had another opinion poll about the German elections showing Chancellor Angela Merkel and maintaining her lead. It fell from 17 to 16%, still, I would say, huge. Okay, so if we move to Euro-Dollar, here we are, still basically in an uptrend despite the most recent correction. Currently at 113.47. Again, we're looking at the MT4 platform, which I'm sure many of you use. So if we're looking at levels from top to bottom, we're talking, if we have a big break to the upside, we're talking about 116.20. Under that, 115, we haven't reached that yet. These are levels last seen last year. 114.45 is the high that we've seen last week. It's the important line of resistance. 113, which used to be very strong resistance, is now support. Look how the pair, despite this correction, couldn't break below 113. Below that, we're looking at 112.30, and then 111.20, and 110.25, and 108.40. All of these are lines that we've seen quite recently. The current range in general is 113 to 114.45, and the pair is trading in range. In this range, it's a correction, but the trend remains to the upside. Okay, let's continue to the pound. Had lots of stuff going on over there, but this week is a bit more quiet. Construction and services PMIs came out as expected. No surprise, the services sector is expanding, but it still points to a slowdown. So we didn't have a disappointment, but economic growth in the UK is slower this year. We knew that for Q1, and we're getting more signs that it's the same in Q2. On the other hand, the pound has support from hopes for a softer Brexit. This is mostly led by the finance minister, the Chancellor of the Exchequer, Philip Hammond. We have what we had last week, a speech also in Portugal by Mark Carney, the Governor of the Bank of England, which talked about removing stimulus. It still also keeps the pound a bit bid, but we're off the 130 levels. Okay, one of the things we're seeing now is the pound sliding because of the US dollar. The next events in the UK, we have on Friday an indicator about the housing market. There have been some worries about house prices after they went up. They went, too far to the upside. And we have industrial output, industrial production from the UK also tomorrow. Next Wednesday, if we look forward to big events, we have the jobs report in the UK, and also their wages are very important. Okay. Pound dollar. Quickly, hopes for a soft Brexit, positive, negative economic weakness, and what keeps us confused is the divided Bank of England, especially if the Governor, Mark Carney, changes his mind very quickly. Okay, let's look at the charts. Haven't seen big movements in the past 2 days in pound dollar, but more excitement elsewhere. But pound, was fascinating just in the previous week. In any case, currently we're talking about, if we look to the upside, 131.30 is out of this chart. That's in case we have a break to the upside. Under that, we have 130.50, the cycle high, 129.75, which was a high right here before the elections. Then we have 128.90, just under 129, the very recent low. Under that, we have 128.20, the initial post-election high, 127, 126.30, and 125. All in all, we're currently in range, currently looking for a direction, but we're seeing here lower highs, okay? Lower highs in pound dollar, that could be a bearish sign. Okay, let's move quickly to commodity currencies. Aussie dollar is still suffering from what we had earlier this week. The Reserve Bank of Australia, the central bank, didn't change rates as expected, but they weren't optimistic either. They're worried about debt in Australia, especially about housing, and like everywhere else, about wages. So it has an ongoing impact, a negative impact on the Australian dollar that lost its momentum. We had some good news tonight from Australia. Trade balance came out a bit better than expected, but the central bank, like in many other places, the central bank has the strongest impact. Again, if we look, another positive thing that didn't change the bigger picture, new forecasts from various banks about Chinese growth remain optimistic, but on the other hand, the IMF talked about the Chinese private debt problem, which is an ongoing story, hasn't hurt the Aussie that much. On Monday next week, we're talking about Chinese inflation data. China is Australia's #1 trading partner. We have a business confidence survey by a bank, by NAB, on Tuesday. And in general, it's correction time for the Australian dollar, quite a significant one because of the RBA. It might be a beginning of a downtrend, but we're not sure right yet. The positive data from Australia, the positive data from China is basically priced in. And well, the most recent downturn is also because of the strength of the US dollar. Okay, volatility. I've been complaining a bit about subdued movements in Aussie dollar. We're seeing it picking up quite a bit. Or a bit. Let's not be too hopeful. And let's look at the charts of Aussie dollar right here. So we're seeing this uptrend, okay, since the beginning of May, but now we're seeing a loss of momentum here, okay? So we're back to the 75 handle. I'm not sure it's a change of course, but certainly more than small correction like I've mentioned around the euro. So levels from top to bottom, 77.50, very high, 77.10, 76.35, and then we're having here this triple lines of support, 75.60, which is the strongest, followed by 75.40 and 75.15. If we fall even further to the downside, we're talking about 74.10. Okay, that's the Aussie. And let's continue. Finish off as usual with the Canadian dollar. Here the trend is much clearer. We're seeing the optimism from the Bank of Canada that continues helping the Canadian dollar. Of course, what does this optimism, what does this hawkishness mean? We'll know a bit more next week. Probably no change in the interest rate next Wednesday, but maybe we'll have some kind of announcement, some kind of a pre-announcement about a potential rate hike later this year. Maybe in October. Oil prices, they have recovered quite a bit, went from 42 to 47. Now they've settled a bit lower. They stabilize still on higher ground at the $45 handle at the moment, 45.50 as we speak. Okay, the rise in oil prices is thanks to what we've seen as limits to the US shale industry. Okay, so output of oil in the United States helped the Canadian dollar, pushed oil prices lower, hurt the Canadian dollar, and now it's picking up once again, but maybe they've reached some kind of a limit. Okay, so if we talked about a recovery of the US dollar throughout this week, and we're talking about the Canadian dollar, so far it is rejecting this strength, at least for now. Of course, tomorrow we have big events, in the United States and in Canada. So we have, before that, today we have trade balance in Canada and also building permits. So Canadian figures. Tomorrow, at the same time as the non-farm payrolls, we have the jobs report in Canada. Most jobs reports this year have been really, really, really great. Okay, so that's going to be a very messy time tomorrow, 12:30 GMT for dollar CAD. Expectations for the Canadian jobs report are for a gain of around 11,000 jobs. It's relatively modest if we compare it to recent months when we had between 30 to 55,000 jobs gained. Okay, so perhaps if expectations are relatively low, and we might have an upside surprise. The unemployment rate is expected to remain at 6.8%. And another figure to watch in Canada is a PMI from the Richard Ivey Business School, published at 2 GMT on Friday. The jobs report is by far more important. Okay, and as I mentioned, the rate decision next week. Dollar CAD, clearly in a downtrend, means the Canadian dollar is rising. Domestic strength, oil, both are helping the dollar, the Canadian dollar. 130 is never too far. If we talked last week, 2 weeks ago, that 130 is a big barrier, we broke under this barrier, okay, but we're not going too far, not yet, okay? Let's show the chart. Dollar CAD here on the OctaFX MT4 platform. We're seeing a clear downtrend if we zoom out just a bit. Very, very shallow correction, I would say. I mean, consolidating, but on much lower ground. For me here, the trend is clear. Anyway, lines we're talking about. If we look to the very top, 135.40, we're far from that. 133.80 worked as strong support until it was broken. The pair never looked back. And same goes for 131.60 right here. Even lower, of course, we have 130.20 just above 130. Okay, so if you see a move above 130, it's not necessarily a break. Look for 130.20. 129.45, a recent low. If we look even lower, we're talking about 128.20 and 127.50 if it really all hell breaks loose. Okay, so that's dollar CAD. So that's it for today. Thank you very much, everybody, for coming, for watching. Comments and feedback are always welcome. Wish everybody a safe and successful day in markets today and tomorrow. If you're trading the non-farm payrolls, trade with care, not too much leverage. Movements can be wild around this event. It's sometimes called the king of Forex indicators. Okay, and stay tuned. We had some educational webinars and we'll have some more coming up quite soon. Okay, so that's it. Thank you very much and see you soon. Thank you and bye-bye.